Okay, so last week we talked about fiscal policy, and today we're going to look at monetary policy. Both of these policies are ways that the government tries to control and impact the economy. And so last week we talked about how Congress does that through the budget. That's fiscal policy. And today we're going to look at another part of the federal government called the Federal Reserve that tries to stimulate or restrict economic growth through something called monetary policy. We've already been through these notes. This is the second part of the PowerPoint, so I'm just going to skip to where we left off in class last week. Okay, the Federal Reserve, which is also known as the Fed, serves as our nation's central bank. Okay, so if a bank needs to get money, they can go to the Federal Reserve, and they are given loans from the Federal Reserve. So money that is printed is first given to the Federal Reserve Bank, which it is then distributed to the nation's banks through our banking system. So the Federal Reserve is a bank's bank. They also oversee the banks in our country and set certain regulations about interest rates and loans and things like that to try to impact the economy. The Federal Reserve, one of their main jobs is to regulate the amount or the quantity of money in the economy. So the money supply is regulated by the Federal Reserve. There's a group called the Federal Open Market Committee within the Federal Reserve, and it is their job to regulate the money supply, and the way that they regulate the money supply is known as monetary policy. And the nation's central bank, the Federal Reserve, has policymakers who evaluate the economy and try to decide whether or not the money supply should be increased or decreased. And the way that they do that is called monetary policy. Okay, just like with fiscal policy, if Congress cuts taxes and increases government spending, both of those have the effect to increase the amount of money that individuals have, which is meant to stimulate the economy. It's the same thing with the Federal Reserve. If they want to increase or improve the economy and our economic output as a nation, then they can increase the money supply. So they put more money into circulation. The opposite, or restricting how much money is in the economy, would have the effect to slow the economy, because if people have less money, they're less willing to spend the money, and so the economy restricts. Okay, the Federal Reserve has three things that they use to control the money supply. It's not just a matter of giving money to banks. It's a complicated process, and so there's three things that they use to increase or decrease the money supply. The first is called open market operations. They control the purchase and sale of government bonds, which we talked about in Unit 1. So if the government decides to sell bonds, that means that they give bonds or pieces of paper to the people, and in return, the people give their money to the federal government. So if we decide that we need to restrict, or if the Federal Reserve decides that we need to restrict the money supply, then we can sell government bonds, because the people get the bond and the government gets the money. If we decide that we want to increase the money supply, then we can offer to buy back bonds at higher rates, which incentivizes people to sell the bond back to the government and get their cash or their investment back. So if we buy bonds back from the people, the bond is returned to the government and the people get money for the bond. So that would increase the money supply. So as I just said, to increase the money supply, the federal government buys government bonds back from the people, and they would issue new dollars to people, which they would then deposit in banks, which would increase the reserves of the banks. And banks could use that money to make loans to other people, which expands the money supply. The opposite of that, to reduce the money supply, we could sell government bonds, or the Fed could sell government bonds. That money would be taken out of circulation, and the process works in reverse. The second tool that the Federal Reserve can use to regulate the money supply is called a reserve requirement. Okay, a reserve requirement is how much money banks have to have on hand at all times. So if your total deposits in your bank is $1 billion and you have to keep 10% of that, then banks would have to have 10% on hand at all times in their vaults. That's known as the reserve requirement. If we want to increase the money supply, we would reduce the reserve requirement. So if banks had to have 10% on hand, if we reduce that to only 5%, then the 5% that they had on hand that they no longer have to have on hand, they can loan that out to consumers, which increases the money supply. To reduce the money supply, the Federal Reserve would raise the reserve requirement, and the process works in reverse. So if they used to have 10% in their vaults at all times, if we raise that to 15%, that's 5% less that banks can loan out to consumers. The Federal Reserve rarely uses or manipulates the reserve requirement as a way to control the money supply because it would disrupt banking pretty drastically. And so we don't manipulate reserve requirements all that often. It's much easier to use the first option, which are the open market operations, to manipulate the money supply. The third tool that the Fed can use is known as the discount rate. This is an interest rate, but it is an interest rate on loans made to banks. So just like an individual goes to a bank and gets a loan for a car, for a home, or for whatever, whenever you get a loan, the fee for that loan is the interest rate that you have to pay back on top of the loan. So it works the same way with the Federal Reserve and member banks. So if a bank goes to the Federal Reserve to get a loan, they set interest rates that banks have to be able to pay back to the Federal Reserve. So the discount rate is the interest rates on the loans that the banks have to pay back to the Federal Reserve. Okay, so banks, again, as I said, can borrow from the Federal Reserve. If we want to increase the money supply, we can lower the discount rate because banks will have more money that they can loan out to consumers because they have less that they have to pay back in interest to the Federal Reserve. So that will increase the money supply. To reduce the money supply, we can raise the discount rate, which is the same as raising interest rates on a loan for your car. If the interest rate is higher, you can't afford loans that are more expensive. So just like an individual loan, if the Federal Reserve raises the discount rate, banks have to have more money on hand to pay back in interest to the Federal Reserve. Therefore, it would decrease the money supply. As I said, the Federal Reserve most often uses open market operations or the buying and selling of bonds to manipulate the supply of money. If the economy is doing poorly, the Fed uses monetary policies to attempt to stimulate the economy. If the economy is doing really well, the Fed uses monetary policies to slow things down. This prevents inflation and hopefully prevents a massive overcorrection like we saw in 2008. We talked about that fiscal policy controlled by Congress can be ineffective at times because Congress just works very slowly. The Federal Reserve, on the other hand, is independent from politics, and so they can make decisions that have quick impacts that their decisions can impact the economy more quickly than fiscal policy can. So monetary policy is more effective than fiscal policy in the short term because the Fed can enact policies immediately. The Fed is also independent of Congress, like I said, so they make decisions that may be unpopular with voters because they're not going to get recalled or voted out of office. Their position is not tied to a political election, whereas Congress is. It is good for the economy, but not great for a democracy because, again, these people are not elected and they have a large amount of control over our economy.